Hi folks, this is the explanation in an abbreviated format for Chapter 10, which talks about the flexible budget. So if you remember from Chapter 9, we had a master budget that we created. You could look at this as something that you would do at the beginning of the year to estimate based on how many sales you're going to have, how much production you need, how much cash you need on hand, how many workers you need, and so on and so forth. So taking that to the next step, then we're just going to now figure out, uh, comparing the actual results for how well we did on the budget. And so the neat thing is that now we're going to compare that, but obviously the numbers that came in terms of actually what we either sold or produced or whatever is going to be different than what we budgeted. So now we're going to use what we call a flexible budget. So that's what's going to happen next. So as I just mentioned, the planning budget, which is what we did in Chapter 9, is for a single level of activity. But then when the actual results come in, then that's when we have problems. So that's why I say here, it's like comparing apples and oranges. So if I planned to sell 500 units and I had a certain budget set out for those 500 units and I wound up selling 600 units, then some of my budget's going to be off because I sold more. Is that bad? Obviously not, but we just need to flex our budget so that we can account for the difference in the volume. So obviously the benefit of this is for mostly the managers because we like to assess ourselves in terms of how well we're doing based on what we thought we should be doing. So we're going to look at this company called Larry's Lawn Service, and this should explain a lot. So they provide lawn care. All the lawns are about the same size. We just sort of simplify things, and they're going to mow 500 lawns. So let's see what's going to happen here. So this is kind of what we did in Chapter 9. We say, hey, we're going to do X amount of business, or we're going to, in this case, Larry is going to budget for selling or for mowing 500 lawns. So based on that, he thinks he's going to charge $75 per lawn. So here he's got his revenue, and then you can see that there's some fixed costs as well as some variable costs that go into creating the total cost. So here's his, what we call a static budget. Okay, so the next thing we're going to do is look and see what happens when the end of the month comes or the end of the period. And in Larry's case, he actually wound up mowing 550 lawns. So at 550 lawns, based on his $75 per lawn measurement, then this was the revenue that he should have gotten. And then you just carry this on down. 5,000 plus 30 times 550 would be that, and so on and so forth. So in a way, what we're starting to do is flex our budget based on the actual results that came in. So on the next slide, you can see that I planned on mowing 500 lawns, so I was going to get this much in revenue, and these were going to be my costs. Well, what happened is I actually mowed 550 lawns, giving me the actual results of all of these things. So now I get to look at this and say, oh, well, look at this. I had a favorable revenue variance. I had an unfavorable expenses in terms of wages and salaries. But if you stop and think about this, yes, it's unfavorable in a way because obviously if I mowed more lawns, I had to pay more gardeners. So my expenses are going to be higher. So it says it's unfavorable, but in the next step, we're going to actually evaluate that and find out if it is truly unfavorable. From a black and white standpoint, yes, it's unfavorable to have more expenses, but is it really unfavorable because we actually mowed more lawns? So let's take a look. Okay, so I've skipped a lot of slides. This one is probably my favorite when it comes to this example. So you can see, I'm going to break this down for you because this is going to make things a lot clearer. Here's my number of lawns. So my budget, what I planned on mowing was 500 lawns. Based on that, because I mow lawns for $75 each, this should have been my revenue. Because I pay my workers $30 plus I have a flat fee, then this should have been my expenses, this should have been my gasoline, and so on and so forth. I should have had net operating income of about $5,000. Now, it's a great thing to set a budget because then we at least know if we're in the ballpark or not. But now what we're going to do is we're going to skip to this column over here. We're going to say, you know what? I actually mowed 550 lawns. So at 550 lawns, I should have taken in this much revenue. I should have had this many expenses, spent this much gasoline, and so on and so on and so on. And I should have made $6,650 if I would have taken all of these cost drivers and all of these formulas and multiplied it out times 550. So you can do it yourself. 550 times $75 should be $41,250. 550 times 30 plus 5,000 should give you $21,550. Okay, so that's how I come up with my flexible budget. Now check this out. The next column are my actual results. All right, so this is where life gets really interesting because my numbers came in, and even though at 550 lawns I should have taken in $41,250 in revenue, I actually took in $43,000. Okay, I can't explain why that is, but at least now I know that my numbers are a little bit off. Now let's take a look down here. My wages and salaries at 550 lawns, I should have spent $21,500. I actually wound up spending $23,500.
Unknown caller.
Okay, so sorry about that. I got interrupted with a phone call. So now I can see that I actually spent $23,500. I should have spent $21,500. So I have an unfavorable, what we call revenue and expenses variance. Okay, and I'm going to take you through this example because if we would have gotten the actual results of $23,500 and we would have just compared that to our budget of $20,000, we would have been really off, right? We would have been $3,500 over what we should have been. But remember, our planning budget was set out for $500. So really comparing this $20,000 to this $23,550 doesn't make sense. Would you agree? So that's why we come up with this intermediate step of this flexible budget, saying, okay, all right, I know I budgeted for $500 and that should have been my amount, but guess what? I mowed $550, so this should have been my amount, meaning that now this number is really the one I compare it to. So the difference between my planning budget and my flexible budget when it comes to this spending is what we call an activity variance. Do you see that right here? That just means that I have a difference between this and this simply because I mowed more lawns. Now, the difference between what I should have spent on wages and salaries based on what, and then compare that with what I actually spent on it, then you can see that I have a $2,000 unfavorable variance. It's better than me just looking at this and going, 20,000 minus 23,500, oh, I'm off by $3,500. Well, not really. I'm actually over by $2,000. Now, why I'm off by $2,000? That is not answered by this, but it gives me an opportunity to evaluate that and do a little bit further digging on where my variances are. Okay, so let's take this one. Let's take gasoline and supplies. So I should have spent $4,950 on gas. I wound up spending $5,100 on gas. So you can see I have a $150 unfavorable variance. Then it gives me pause for cause and says, okay, why did I spend more on gas? Did the price of gas go up? Does maybe my formula here need to be adjusted? Or did somebody spill some gas, or I don't know, there could be many different reasons, but the point is that it gives you an opportunity to go and evaluate that. So that's why we have basically 3 columns: my planning at 500, my flexible budget based on what my actual quantity was, and then there's the budget for that, and then what my actual numbers are here. So this is my favorite way of doing this. For an exam, I would probably know this slide very well and know the difference between an activity variance versus a revenue and spending variance. And if you lay it out like this, it will become very clear. The last point of this chapter is really dealing with multiple cost drivers, so you can see that now my formula has changed. So I have a couple of different cost drivers in this one, and you can just see that whatever my costs are will be adjusted by these two different cost drivers. If you're ever asked a homework question or a test question, you will be given the amounts to plug into both Q and H to come up with your amounts. But the final result of this type of a spreadsheet will hold the same. All right, so I believe that does it for chapter